I'm going to go ahead and get started. So welcome to the Metrics That Matter webinar with LedgerGurus and Common Thread Collective. We're going to be exploring the Diagnostic Toolkit for e-commerce sellers. I am Stephen Brown. I am the COO of LedgerGurus, and I'm also a co-owner of a direct-to-consumer brand, Sole Toscana. With me, I have Richard Gaffin. Richard, do you want to introduce yourself?
Yeah, my name is Richard. I'm the Director of Digital Product Strategy at Common Thread Collective. We're an e-commerce growth agency. And so my job is essentially to create public-facing tools that people can then use to sort of aid their own e-commerce growth. It's one of many hats I wear, but that's the main one, I'd say.
The genesis of this webinar was I was listening to I've been listening to the podcast that Richard and Taylor over at Common Thread do for many months, and they had this episode on the e-commerce diagnostic toolkit, and it just really resonated for me. One of the things that they talk about was, how to address challenges in an e-commerce business, whether it's low or no profitability, growth limitations, not sure where to go, not sure what to measure. And this diagnostic toolkit was a really beautiful set of metrics that I think helps a business focus on what they need to do. Hold on one second. Can you still hear me, Richard? I just got a question around audio. Okay. So Kelly, can you just jump on? Somebody says they're having audio issues. So the goal of this webinar is to show you how to measure these key metrics that measure a business's growth potential. What you're going to learn about is the 10 key metrics that make up the e-commerce diagnostic toolkit that measure performance across operations, customer acquisition, and retention. How to break down where your brand is over or underperforming and get a clear picture of your business growth opportunity. With that, I'm going to turn it over to Richard to take lead. So Richard.
Yeah, so I think maybe to step back a little bit, I just want to talk a little bit about what the e-commerce diagnostic toolkit is. And essentially maybe a way to put it is it's sort of a glorified audit. It's a sort of a DIY audit in a sense, but it's a different sort of audit than we've ever seen before. At our agency, I think what part of the impetus behind building this thing was we discovered that there were certain clients that we would have where, because certain elements of their operational mechanics, inventory management, cash flow, costs weren't ideal or weren't optimized, it really affected our ability to do marketing for them. And that kind of grew into this idea of creating an overall business assessment that evaluates the growth potential of your business, right? The extent to which, like, if you hit these certain metrics in a certain way, it means your business has a lot of potential to grow. And then for us, just in terms of our own self-interest, that gives us an indication of whether or not a client's going to be, we're going to be able to win for a client or not. But obviously, like the benefit of it extends beyond just an agency-client relationship, also for brand owners, for anybody who's trying to grow a business in e-commerce. Having this information, we think, is actually absolutely mission critical. So this is kind of the tagline, or whatever you want to call it, for the e-commerce diagnostic toolkit here, which is the only way to move forward is to know exactly where you stand. And part of the reason that we came up with that is that's maybe the number one thing that we hear from potential clients is a lack of understanding, through no fault of their own, really. Like, everybody has this problem, a lack of understanding about where they should go next. And that might come from, hey, we're really struggling and we don't know how to fix this, but it also may be like, we're doing really well, but we know that there's more. What do we do next? How do we get eyes on the data to understand what the best next step might be? So let's move on to the next slide here. So this is really like the question that we want to answer, or maybe the value that we want to provide, or that we set out to provide with this tool, which is to say, how would it change the way you run your business if you could precisely identify your weak points and expend all your energy running after your biggest opportunities? And I think the answer to that question is, like, it sort of answers itself. It would change everything. And I think the ability to eliminate the amount of, like, mental effort required and also honestly, like emotional effort it requires to say like, what is the next thing that I have to do? Thinking through that element of strategy really is a drain, I think. And to have the idea behind the diagnostic toolkit is to give sort of a guiding light to say like, hey, we know there's a million things you can do, but hey, how about focusing on these one or two things because we think that they're going to be most impactful to your business. So let's move on to the next slide here. Before we get into the rest of this presentation, which the bulk of this will be breaking down the 10 metrics that we evaluate a business's growth potential on. We need to talk about duckweed. So duckweed, this is an analogy that we use to sort of set up why we came up with this product, right? This was kind of like primarily a lot of the thought work was our CEO Taylor, and a couple of years ago, and really last year too, like e-commerce was going through a pretty rough time, and in some ways it still is. And one thing we sort of became obsessed with was like, how do we just, what type of brand is able to survive no matter what? And so as we were trying to think of an analogy for this, the one that came to the forefront was this duckweed. So if you guys have probably all seen it before, it's essentially like a little weed, like a floating aquatic plant that grows on the top of ponds. And you can see kind of the duck swimming through it. It kind of looks like grass. So if you're not careful, you could step in and fall in or whatever. But the thing about duckweed that makes it different from almost every other plant in existence is its DNA is such that it'll grow when it's light and it'll grow when it's dark. So duckweed grows at many times the rate of any other plant because it continues to grow when it's dark outside. So really that's how we want to think. That's what the e-commerce diagnostic toolkit is meant to discover is, are you a brand that is able to grow in bad times and in good times, in the dark and in the light? And if you're not there, what are the things you can do to bring yourself to a point where you can grow in the dark and in the light? So let's flip on to the next slide, and we'll start talking about the 10 diagnostic metrics. And again, like as Stephen mentioned, if you have any questions on any of these specifically, feel free to jump in at the end. I think it'll be kind of easier to gather them. But so metric number one, and again, I want to set this up in contrast to the metrics that most marketers usually measure are like on platform return, basically, right? Facebook ROAS, Google ROAS. And what happens is those metrics, because they're not tied to the overall profitability of the business and all of the other business realities that exist for an e-commerce brand, they end up giving limited information and creating scenarios where the pushing after those metrics actually doesn't really help the most important thing, which is your bottom line, right? Which is building a profitable business. So we wanted to discover sort of 10 key KPIs, you could say, that are actual indicators of whether or not a business has true growth potential beyond simply like the Facebook ad account is performing really well or really poorly or whatever. So the first one is, this is sort of, I think this terminology is maybe an invention of ours, but it also exists in other ways. We call this cost of delivery percentage. And so this is essentially, so I mean, most people would measure COGS, right, as a percentage of revenue, like our COGS is 20%. We sort of upgrade that or evolve that to cost of delivery, which is all of the variable costs that go into selling a product. So COGS obviously normally includes the cost of manufacture. Often it also includes the cost of like the landed COGS, right, which is the cost to ship the product to you. But then we also include things like the cost to ship to the customer, tax paid, fees levied by, let's say, Shopify or whatever on each individual purchase, credit card processing fees, any fee that scales with volume of sales, right? And that's just,
I can tell you, we would call it, from an accounting perspective, cost of sales. It's not something you usually find in a profit and loss,
right.
But anything that's related, any cost related to the sale of the product.
Right. And so the reason that we want to measure that is like, it gives us a good measurement of, or it allows us to judge how profitable our marketing is, right? Because you run an ad, you make a sale. If all of the costs associated with that sale, which have to include things like credit card processing fees, pick pack fees, whatever, if all the costs associated with that one sale leaves you in the negative, then you have a problem. Even if your ROAS looks great, there's still an issue if your AOV plus CAC, or rather AOV ends up being lower than CAC plus cost of delivery. Now we measure CAC as a separate thing altogether, but this is the first thing, right? So CAC is, like most people in marketing measure CAC. We want to include all of the costs, including some of the inventory and operational costs that go into making the sale. All right, so let's go to number 2 here. OpEx percentage. This is straightforward. Everybody measures this. This is just your fixed costs as a percentage of revenue. There's there can be some argument about what's included as OpEx and what isn't. Are agency fees OpEx, or are they variable costs? But generally speaking, we want to say, like, any expense that your business has that does not scale with sales volume, or scales with sales volume very slowly. Like, for instance, depending on your business, this could be different. I don't know. But one thing that often gets asked about is, like, hiring. Is hiring against a volume of sales, does that count actually as a variable cost or as an OpEx? To which I would say, because we want to get as close to, like, you don't have to hire a person every time you make a single new order. At least I hope you don't. That's why we want to include it as OpEx as well, because it doesn't directly scale with sales volume to that level. But you can also sort of figure it out for yourself. But we would say, generally speaking, OpEx is anything that doesn't scale directly with sales volume.
So this would be like software, payroll, rent. Let me ask you about, like, agencies. Like, agencies, the inputs that go into an ad copy, would you put that in the cost of sale, or would you put that in your operating expenses?
Generally speaking, we put agency fees in OpEx.
And I would agree with that. That seems like the natural division, right?
Yeah, because again, like, it also depends, like, how is your agency assessing fees? If they're assessing fees as a percentage of ad spend, maybe there's an argument. But generally speaking, you're probably going to have them on a fixed retainer, which means that the amount that you pay the agency doesn't necessarily grow with sales volume. It may grow with spend volume, but it's not directly correlated, I guess.
What we've seen is an accounting firm focused on e-commerce. Most of your spend is in your cost of goods, your product costs, land and product costs, your ad spend, which again would be that cost of delivery or cost of sale, as we would describe it, and then payroll, right? Those are, like, kind of the fulfillment I put in there as well. Those are kind of your big costs, your product costs, your fulfillment costs, your ad spend, and your payroll. A lot of businesses get crazy though. They'll spend way too much on agency. And I think the model here kind of helps you look at it. And one of the things that the Diagnostic Toolkit does that I loved is it gives some benchmarks for what is healthy.
Yeah. And well, at the end of this, we'll kind of get into what we would consider to be healthy benchmarks, or growth forward benchmarks, maybe, for some of these. But yeah, I think like making sure you have an eye on this metric is really important, because this stuff can really balloon if you're not keeping an eye on it. Like, there's all kinds of different ways, like office costs, like, but the cliche would be, whatever, we have the ping pong table in the arcade, whatever, you know what I mean? Like, office costs, especially as sort of like a quality of life thing, can often balloon. And we've seen this with people filling this out. Like, they'll be like, wait a minute, I didn't think our OpEx was that high. And it is. And so you have to keep an eye on it. So, okay, let's move on to number 3 here. And this is the one that I'm actually, from an accounting perspective, I think I'm most interested to talk to you about, Stephen, because this is, as I'll say, this is somebody who's primarily a marketer. This one was super new to me when we threw it in. And, well, I say throw it in as if it was casual. It was not, because we'll get into this a little bit later, but our agency also owns a skincare business called Bamboo Earth. And so we have to be thinking about the operational aspect of e-commerce all the time as well. And one thing that really came to the forefront, especially during the sort of lean times that e-commerce has been having recently, is the importance of cash flow. And so I'll say this is our definition of cash conversion cycle, which is the number of days it takes to turn invested cash into cash on hand. So essentially that would mean you pay for inventory. How many days later do you sell that inventory and then receive the cash for that inventory? So there's 3 sub metrics that play into this. One is days of inventory outstanding, days of sales outstanding, and then days payable outstanding. And it's, I think, the first 2, days inventory plus days sales minus days payable, I think is correct. Steve, you can correct me if I'm wrong on that. But the idea is it's like, so days inventory is like, how many days does it take you to, from the time that you purchase inventory to the time you sell it, how many days is that? Days of sales outstanding is like when you're making sales on credit, how long does it take people to pay their bill? And then days payable outstanding is like, how long do you have to pay your bills, right? And so the idea there is to get a sense of like, how much cash do you have on hand at any given time? How much, and because having cash means the ability to make decisions, and that's a critical metric to understand when you think about like what resources that you can pull on to actually grow. So I don't know, Steven, do you have any accountant's perspective on this?
Yeah, I love that you guys have this metric. I think it's super important with any product-based business. There is a question around how do you calculate it with multiple SKUs. The short answer is as an accountant, finance professional, there are some shortcuts using your profit and loss and balance sheet that allow you to kind of look at the aggregate products to come up with this number. I'll give a little anecdote on this. When I was in MBA school, we actually did a case study on this with Dell. Dell in the 90s pioneered the just-in-time, and they actually came up with a negative cash cycle in that they created a supply chain that was so fast and so short that they were able to take, somebody would do an order and pay for the order before they even got started building the product. And they were able to streamline the delivery of back then it was desktop towers for the most part. They got it so fast within what was a reasonable customer expectation that they got cash in hand before they ever had to spend anything on product and delivery costs.
Mm-hmm.
And that became the model in my, I think it was an accounting class, for how you the best practice for a business to run. And a lot of computer manufacturers followed suit. I think Apple really does this a lot of times, because if you order a device from Apple, you'll see, oh, it's being manufactured in their facility over in China. And so it's really hard to accomplish as a consumer product brand. I think you have to have a lot of scale to come up with a negative cash conversion cycle.
Yeah.
But this makes or breaks a lot of businesses, because your cash is critical. And I think it's more important today because the cost of lending is so much more expensive than it was 3 years ago. The supply chain is, while it's better than it was in 21 and the beginning of 2022, it's still slower than it was in 2019. And it's just a different environment. So I think getting a good handle on the cash conversion cycle and having the shortest cash conversion cycle possible is excellent.
Yeah, no, I think it's definitely, and the reason that we ended up including this metric is having operated our own business, like we understand how mission critical it is, especially for businesses that are in like the 0 to $1 million to even 10 million, whatever, like in the startup phase, especially when the capitalization of the business is based on how much money that you can make off the product that you sell. If you don't have like investment capital, and again, as you mentioned, like investment capital is not so easy to come by anymore, then understanding just like how much cash that you have on hand at a given time and improving that becomes super, super important. So it would probably be a whole nother webinar that we could do on ways to improve your cash conversion cycle, like, cash on delivery from your supplier to, I don't know, figuring out how to like sell less on credit, so on and so forth. But
I would argue, Richard, that we could have a webinar on each one of these metrics. There's so much depth behind them.
Yeah, that's probably true. All right. Let's move on. So those first three are really the operational metrics. These are more of the marketing metrics. And again, we always like to stand these up in contrast to just single channel ROAS. That ultimately is a fourth or fifth tier metric. What's more important is looking at things like 60-day LTV percentage. So this is the average percentage increase in customer value 60 days after first purchase. So simply somebody pays, maybe their first order is $100, and then on average 60 days later, they're worth, maybe they make another purchase and maybe it's $200. That would be pretty big, but let's say it's like, they become worth $150 to you or something like that on average, right? That is a great metric to look at, to think about how long you can float a loss on first order. And we'll get into first order value because that's another metric of, that we use here as well. But I think the idea is that if you want to grow, you want to be as close to break even on first purchase as possible. And that's because as you try to reach more people, your CAC, your customer acquisition costs, how much you're paying for somebody on Facebook, let's say, will inevitably go up. And so in order to grow, a rising CAC is actually a good indicator that you are spending more, that you are growing your customer base. But then, of course, you also have to make money on those sales, right? You can't be cash negative with them. So what 60-day LTV percentage helps you measure is like, okay, if my customer value grows this much in 60 days, it means I can actually take a higher CAC. And if I can take a higher CAC, it means I can actually reach more people, grow my spend volume, grow my sales volume as well. So I'll give a little sort of semi-anecdote here from our own brand, again, Bamboo Earth. We were losing on first order terribly. And this was probably 2 or 3 years ago, like I want to say March of maybe 2019, so 4 years ago. Our Facebook ROAS was terrible. Our first order revenue we were losing money on first purchase. We were thinking about shutting the business down until we looked at specific cohorts and were able to see that within 60 days, they actually grew so much in terms of their value to us that actually in 60 days later, we were above break even on that first purchase, right? And so actually we're like, oh wait, we can just lean into this and our bottom line will be okay. And we were able to grow. And so we've grown probably tenfold since 4 years ago, just with, I will say, a negative first order value, because we understand that in 60 days, our revenue will increase enough to float that sort of initial CAC, right? So yeah, I don't know. Anything you want to mention here, Steve?
No, I mean, I think I love the way you're thinking, with the dynamics being more than just what is the average order value, but like how much growth are you getting from that customer?
Right. Yeah. And I think it's easy. Like one reason we had to come up with this too, I think, is that oftentimes customer LTV is measured over the course of like an entire lifetime. It's such a vague metric in terms of like what is the time period?
Well, it's like what is the lifetime of a customer? Because for some businesses it could be years. It could, for some they might not even have much of a lifetime beyond the first order.
Yeah. And so what are the increments of that lifetime that we can break it down into to sort of understand what our own sort of position is relative to that? So okay, let's move on to the next one then. This is basically the same 1 year LTV percentage. This is the average percentage increase in customer value 365 days after first purchase. So if 60-day LTV is a good indicator of your short-term retention, this is a good indicator of your long-term retention. Are people sticking around for a long time? Do you have a product that they can keep coming back for? Obviously, like let's say subscription products will be better at this than other types of products, but it's also a good indicator of like there may be an opportunity for you to sell more often over a longer period of time. Okay, so
I've got a question. I've got a question that's related to what we're talking about. And they say the question is: would you focus first on CAC, customer acquisition costs, or on AOV, average order value? CAC seems harder and longer to get down.
Yeah, that's a good question. I mean, there's so many different schools of thought on this, but I would say, yes, there are some things that you can manage when it comes to AOV. Primarily, it's like, okay, so the easiest one is like just raise your prices. The second one I would say is like thinking about the actual mix of SKUs that you're selling on Facebook or whatever platform. So one thing that we'll discover is like people are like, well, okay, let's say for a generic apparel brand or something, our best seller is our shorts. But the CAC on our advertising, let's say, is $30, but our shorts go for $20 a pop. That's going to end up being a problem. And a lot of the times we'll take over an account and see that people just because it's the best seller and they know that they can they can actually get sales on it or whatever, they'll continue to be pushing the shorts that are then losing money, right? When in actuality, let's say they have women's leggings that cost $50, but the CAC is still $30. Then all of a sudden, because you're changing up the mix, even though the sales volume may be lower, you're still going to be more profitable on first order because you're picking the right AOV product for the CAC that you're getting. So I agree. Like, yeah, CAC is tough in terms of I think we have a tendency maybe to overestimate like how much control we have over that. Like if we just make better creative, the CAC's going to come down. And like that can happen, but it's like it's pretty hit or miss in terms of like your actual the reliability of your ability to affect that number. So I would say, I mean, there's other ways that you can bring CAC down as well. And in the actual e-commerce toolkit, there's sort of a final report that walks you through certain tactics that you can take to both raise AOV and lower CAC as well. So I would say, like on the AOV side, maybe I would initially suggest thinking about your product mix and then go from there. So
another question is, what is a good target to aim for on the 1 year LTV?
We will get to that at the end. So I'm going to share after we talk through each one individually, I'll share the specific benchmarks with these as well.
Okay. Well, let's keep going
right.
so we can get to those benchmarks.
Let's do it. Okay, FOV to NCAC. This is the ratio of first order value to new customer acquisition cost specifically. So first order value is AOV minus cost of delivery, right? So minus all of the variable costs, minus CAC, and then divided by CAC. And that gives you the ratio. Basically, it's sort of like, you could say advertising to sales ratio maybe is a similar metric to this. But this is just giving you an idea of whether or not you're profitable on first purchase or not, right? So we've already talked about this a little bit, not too much more to say there. Let's go to the next one here. Number 7, this is your number of distribution channels, how many revenue sources your brand has. This is as simple as like, don't put too many eggs in one basket. If you are, let's say, only an e-commerce store, that's going to be more volatile. It's basically, simply like diversify in terms of like your sales channels, and you'll be in a better, more stable position.
Let me ask you a clarifying question here. Would you,
Sure.
the way you guys have in your parentheses here, would you consider Amazon and Shopify 2 channels?
Yes, we consider them separate channels for sure.
And like in wholesale, you could be in like, Sephora and Nordstrom's, 2 channels.
Yeah.
Okay.
And then we would also say like, there's all kinds of other things you can think about too. Like one of our brands we used to have did like government contracts or like big B2B like gifting things with other companies or whatever. Like if there are other channels you can open up that go beyond the D2C thing as well, like that's also really important. Okay, let's jump to the next one. Organic traffic percentage. So this is like, again, another problem that we see with a lot of brands that come in is that they're over leveraged on paid, basically. And because paid revenue is so volatile, and you have to pay for it, whereas organic traffic is much more stable, and it also doesn't cost anything. A higher percentage of organic traffic is going to create a more stable growth environment than a higher percentage of paid traffic. But it's just, it sort of stands to reason, but it's not something that a lot of people measure. So that's another important one. Then
let me ask you a clarification on this. So for example, organic, that you obviously think SEO, I've got, SEO that drives traffic. What about like SMS marketing or like a post pilot? Would you consider that paid or organic? Because you're paying for it, but it's like, how would you qualify that?
Yeah, I would say, that's a good question. So I guess in these circumstances, it's like if you're paying like maybe this is what you're talking about, I don't know, but like a monthly fee to use this, is that what you're saying?
Yeah, like you have monthly tools for SMS. You like post pilot's a kind of a weird one where it's in between because there's like a fee for how many mailers you send out.
Yeah.
Maybe that's a little bit of a gray area, but like SMS marketing or email marketing where I'm paying a subscription and I'm just blasting my customer list. So it's not really, I am paying something, but it's kind of organic. Would you consider that organic, or would you consider that?
We would consider that organic, just because you're not paying for the traffic per se.
Yeah.
Like if every time you hit send you had to pay, we would consider that paid.
Gotcha.
Where like on Facebook, every time an ad is shown, you pay a certain amount. That's how I would think about it.
Okay.
All right. So let's jump to 9. 1 year LTV to NCAC. This is again just like FOV to NCAC, first order value to new customer acquisition cost. This is 1 year LTV to new customer acquisition cost, and this is like a good sort of way to think about your return on investment, which is to say, like, if I put $1 into this business, after a year I get $2 out. that's a pretty good investment. And so it's kind of a way to think about like, what is the long-term like value creation of your brand? So not too much more to say there. That's pretty straightforward. So let's just scoot on to the last one.
I'm going to go
Number
back
10.
to one. We had a
Sure.
question. I don't think there's an easy answer to this, but what would be the
Sure.
best way? Be curious your thoughts. What would be the best way for a sub $2 million brand to get into wholesale?
Yeah, that I am not an expert on, and I don't have answers for. But
That's kind of how my response too. And I wanted to laugh at it, not because it's a bad question, but because I think it's it's like,
yeah.
I don't know if there is an easy way for a sub $2 million brand to get into wholesale, unless you get, the biggest challenge with wholesale is you're talking about buyers, you're talking about really complex business relationships and terms. Usually they're going to come to you.
Yeah.
You're not going to go to them if you're that size of a brand. You've got to be really hot, and maybe a buyer's, maybe get friends with buyers and wholesale channels that you are interested in. But it's a hard play at that size. One of the cautions I'd say from a finance perspective of going into wholesale is the terms on wholesale, when we talk about customer cash conversion cycle, can be very long. They can be 90 days to 180 days before wholesaler will pay you on a sale that occurred in their channel. Meanwhile, oftentimes you've had to incur the cost of that inventory. So while the diversification is really valuable, I would say wholesale is something you have to be really, really thoughtful about, because it can be very expensive and complicated to sell through. That's kind of my thoughts from a finance perspective over our years of working with different brands.
Yeah. And I would say like maybe as a general rule, because I guess I don't see too many brands at that level being diversified beyond D2C at all, I would say, which is not necessarily like a bad thing. Like I think the general advice that we give would be get as good as possible at one thing before you expand into another. But I will say, like most often the second distribution channel we see is like Amazon, because the sort of barrier to entry is pretty low. It's almost the same thing, But
all right, let's bounce back. We're at number let's see, we were at 10. Okay.
Yeah, number 10.
Hold on. So that's 9.
Yeah, next slide.
Come on, slides. Here we go. 10. Okay.
There we go. Okay, revenue peaks. So this is again something we also sort of made up, but it's the idea is like the number of months in the year where revenue outperforms the mean by at least 25%. And what that means is, or what that's a measure of is, are you taking advantage of the entire year to build moments where you can sort of spike revenue? And I think one of the reasons we kind of came up with this is we would see this is a big sort of untapped resource, I think, for a lot of brands, which is to say, you go in, everybody has a peak. Usually everybody has a peak around Black Friday and Cyber Monday, of course. And part of the attitude is that, oh, March, nothing really happens. April, nothing really happens. Oh, this is a downtime for our brand, whatever. Our challenge then with this is to say, look at the entire year and figure out ways that you can fill in those valleys and actually sort of invert them and turn them into peaks. And so what I would say is like, seek out down months and think about, maybe this is where I drop a new product. Maybe this is where we do a special, let's say summer sale or whatever. Maybe this is where we take a lesser known holiday and we create some sort of promotion around that. And the idea is that, like, yeah, there's a lot of opportunity to sell, but you have to create moments that people will buy into and then buy your product around as well. So most brands, I would say, have one peak, which is Black Friday, Cyber Monday. Some brands will have two, which would be like, let's say, for instance, like we used to have a brand that made wallets out of baseball gloves. And so you can imagine they had a big gifting peak on Father's Day, because it's like, there's a slam dunk Father's Day gift. So it's like, it's sort of a no-brainer. But then they have to think about, like, in non-gifting moments, what do we do to maximize the revenue potential? And to some extent, like, you usually, I'll say, can't invent like, oh, it's baseball glove day today. Like, that's a reason to buy. But there are other things you can do, including new product drops, finding MVP customers who are buying year round, figuring out what makes them tick, pushing stuff towards them, whatever. So
And I
Yeah,
think
so
in a macro example, we have, this is not, you have to be very big, but like Amazon Prime Day, right? They invented a
yeah,
freaking holiday in the middle of the summer because
right,
they're Amazon, and it's become this Goliath
yeah,
of sales for
yeah.
them.
We have another brand that we work with they're probably in the 50 to 100 range, maybe 100 million, and they never run sales. I should say this: they never run discounts. On Black Friday, they do buy two get the third free, buy one get one free, right? So, or gift with purchase, right? So it's still not a discount. They run one discount on International Women's Day, and that is their biggest sales day of the year, because they've trained their audience to understand that they never discount except for this one time. And so essentially they've created a sales moment, even though they're not that big. They've created a sales moment by sort of training the customer around an expectation on a yearly cadence. And yeah, I think there's a ton of opportunity. It's a really under appreciated element of e-commerce, especially, which is creating a marketing calendar. Instead of just thinking about what's my evergreen strategy going to be, think about how you can create moments throughout the year. Cool. So, all right, those are the 10. We move on to, we'll sort of talk about what the output of the diagnostic report is, right? So this is for our brand, Bamboo Earth. The diagnostic toolkit outputs something that we call the GQ, the growth quotient. And the idea it's sort of it's like IQ, right? Your intelligence quotient or whatever. And so we set a threshold, right? If you hit the benchmarks that we set for each one of these metrics and you hit them perfectly, you'll have a 130 GQ. And that just correlates to 130 is the IQ score you need to get into medicine. So that elite level, let's say, or the level at which we can sort of confidently say your brand has a ton of growth potential, that, basically it's the fire's already lit, we just need to put a little lighter fluid on it or whatever, that's 130. And so you can see that our own brand, Bamboo Earth, is below that benchmark because there's certain places that are affecting this score. And so the idea is, let's go to the next slide. The big reveal, these are all of the benchmarks that kind of go along with it, is that depending on how much you exceed or miss the benchmark, it adds or subtracts from the GQ score of 130. So if you're missing all of these by a lot, it'll sort of subtract those scores from your GQ and give you a low GQ. And then if you exceed them by a lot, they'll add, potentially there's conceivably no upper limit to how high your GQ score could be or how low it could be. So I'll go through each one of these one by one. These are the detailed results for our brand, Bamboo Earth. Again, the benchmark for cost of delivery, 30% or lower. For OPEX, 25% or lower. For cash conversion cycle, and this is even where we've had, well, honestly, not even some disagreement. I do think that this is maybe a little bit of a too high of a bar, but a 0 day.
I wanted to ask you about this. How often do you come across brands that have a 0 or better cash conversion cycle?
Very, very rarely.
Yeah. Did you set the bar too high? I mean, that's probably one of my questions.
Yeah, there's a possibility of that. I think there's two ways to think about it. One is that if a 130 GQ score is the most elite level brand, then I would say yes.
True.
Having a negative cash conversion cycle is a hallmark of a brand that's really crushing it across.
And the example I gave with Dell, it can be done. It is, you have to be very good with your supply chain. You have to be really smart with how you execute, but there are examples out there of businesses that have figured this out.
Yeah. And I think the one that kind of sparked us talking about this was, I want to say it was Gymshark released their P&L on Twitter probably 6 months ago. And part of what it revealed, or rather, it wasn't just their P&L, it was like a lot of their, maybe not their financials, but just some of their data, right? And what it revealed is that they had a negative cash conversion cycle, which Gymshark is like an apparel brand. And that's kind of crazy. Like their ability, like their supplier terms are so good, their sell-through rate, whatever. So it is possible, but it is also unusual. And I think too, there's an argument to be made that for certain industries, a negative cash conversion cycle is impossible. Like I think if you're selling furniture or something like that, or like a big ticket item that has like a long lead time, takes a long time to manufacture, getting this number that low is going to be difficult. But for the time being, for V1, it's set at 0. 60-day incremental revenue growth percentage. We had a question about this earlier. 30% growth after 60 days is our benchmark. We would say, like, if a brand is at that or above, they're in a great position in terms of their short-term retention. Then 100% revenue growth after a year, another great indicator that you have a solid, committed customer base that's going, and your long-term retention efforts, which include things like how good is your customer service, what's the experience of the product? Are they having, like, as they say, a delightful experience with it that's getting them to tell their friends and makes them want to come back, right? Yeah, our benchmark there is greater than or equal to 100%. Then first order value, FOB to NCAC, our benchmark is 0, like break even. If you're above break even on first order, if your first order value rather is above break even, you're in a good position. Number of distribution channels, we want to see 3 or more. Percentage of organic traffic, 50% or higher. And then 1 year LTV to new customer to NCAC, 0.5 or higher, and then number of revenue peaks, 4, right? So if there are any specific questions about those benchmarks, I'm happy to answer them. But I think what I want to go through this, or what I want to speak to with this is how we use this then, or how you can even use it to diagnose issues with the business, right? We'll call them weaknesses and opportunities. And I think you can see really clearly that Bamboo Earth, so if you look in the rightmost column, you'll see whether or not there's a positive or negative effect on the GQ score. So right now, the biggest negative effect is cash conversion cycle. So that can be brought down, but I would say, generally speaking, maybe, let's say if we were looking at this as a marketing agency, that wouldn't be the first place we would go. We would look at probably percentage of organic traffic. We're at 46% against a benchmark of 50. So that means, and this is something that I can definitely confirm, like, Bamboo Earth has an issue with being over leveraged on paid. We have a difficult time growing our organic traffic as a percentage of revenue. So that's a clear next step that we need to take. Like, how do we figure out how to reduce that and how to grow our organic traffic? Number of distribution channels, there's a -5 impact there. That's definitely a place that we could expand. That would be important. Number of revenue peaks, I think this is a big one. Bamboo Earth peaks, it says, the score says 2. That's because our calculator calculates November and December as 2 different months, because of course they are, but that doesn't really mean they're 2 different peaks. So in essence, the real interpretation of this is that Bamboo Earth just has 1 over the holiday, which means all the other 10 months out of the year are, let's not necessarily being ignored, but there's a big opportunity to create spikes in revenue, to create moments that people sort of feel compelled to come in and buy. And then, yeah, our 1 year incremental revenue growth percentage, there's a negative impact there that could be grown. But then you'll see too, like, our first order value to NCAC is actually OSL negative, which has an impact on our GQ score. But the impact OSL isn't that high, because you can see that our 60-day incremental revenue growth percentage actually has an impact of 4. It's over the benchmark, which means that we can float those costs, or we can reasonably assume that we can float those costs over that period of time, because our LTV grows more than 30%. So you can begin to see how this becomes a pretty at-a-glance way to diagnose issues with the business and then to take next steps. So I
have a handful of questions for you, Richard.
Let's go.
Kind of a quick one. Where would you put return costs into the cost of delivery?
Yes, we would calculate cost of delivery, or rather, sorry, not necessarily. We don't calculate return costs as part of cost of delivery, but the percentage we calculate, like, from your total revenue, which would include returns subtracted from that number, we calculate the percentage of that revenue from cash on delivery based on the revenue number with returns taken out, if that makes sense.
Okay, next question. This is around the cash conversion cycle. Will you try and negotiate better terms with suppliers as the biggest pillar, or driving down the time to purchase, which can be difficult to accurately track? Let me take this one. There's a number of levers that you can pull on the cash conversion cycle. I'll give you an example. The brand that we purchased, Sole Toscana, we had 70-30 terms, so we had to put 70% down to initiate manufacturing, and then 30% upon receipt. And we broke that up into 30, 30, 40. So sometimes as you grow, that's a really good place to start with is manufacturing terms. Other thing is, that will improve cash conversion cycle is the terms of when you have to pay. So there's a lot of tools out there that you can do that will extend the time before you have to pay something back. I know there's some credit cards out there. It's probably a place for a different conversation that have terms on how long you have to pay back. So essentially you're looking for the summary for cash conversion cycle is getting your money as quickly as possible, which is a little bit harder on a consumer product business. It's hard to get your money sooner than when it's time to fulfill, and extending the amount as long as possible for which you have to pay any of your vendors, suppliers back.
Mm-hmm. And we also have, so if you run this report, if you have a positive cash conversion cycle, a little thing will populate that will push you to an article that we have about simple ways that you can reduce your cash conversion cycle. These are all sort of like from our experience. So like owning parts of your supply chain, for instance, reducing your number of SKUs, working with local contractors. There's a lot of different ways that you can practically bring that number down. So.
And then the last question for now, Richard, is where do you find your source of truth for organic traffic sales?
Source of truth. Oh, like how do we measure it?
Yeah. How do you, I mean, that's that I know in Shopify, there's a report that allows you to see that, right?
Yeah. So what we do is, and this is how everything in this report is calculated. So we have a proprietary data analysis platform called Statless. And what that does is it brings your information from Shopify, from Facebook, from Google, from Klaviyo, like whatever email client you use, it brings it all into one place. And then it calculates a lot of this stuff for you. So if you actually get the Diagnostic Toolkit, a lot of what you'll be doing is walking through Statless and finding the information to pull. Now, Statless is, of course, an extra cost on top of this. That's why we offer 30 days free of Statless with every Diagnostic Toolkit, so that you can just do it for free and then cancel your Statless subscription if you feel like it's not for you or you don't want to continue or whatever. But so for us, like, yeah, the percent organic traffic is primarily, I think, pulled from Shopify, so you could probably find it there yourself. But there's also a report in our system that will show you the percentage of the pie.
And Amazon will give you like attribution of how many sales came from paid versus organic.
Yep.
All right. Another question that popped up. Is the first order value to new customer acquisition cost ratio not just the contribution margin on a first order divided by cost ratio? I need to think about this for a half second.
Is it not just contribution? I think based on my interpretation of that question, it's isn't FOB to NCAC just contribution margin? I think that's what it is. And I think,
let me see. He said clarification, contribution margin divided by customer acquisition costs.
Is a contribution margin divided by customer acquisition cost?
Is that the same?
Is that what it is? Yes, I believe so. It's like first, I guess you could frame it as like, yeah, first order contribution margin or something like that. The idea behind it being calculated separately from overall contribution margin is because it's specific to new customers and it's specific to first order. So it's let's say, call it like a subcategory of contribution margin would be maybe a way to frame that.
Okay. That's everything.
Cool. So yeah, I mean, I think that kind of wraps it up in terms of just talking through what's included in the Diagnostic Toolkit. But the idea here is, go ahead.
Let me ask you a couple of questions.
Okay.
I'm really curious, why these 10 metrics? How did you guys come up with these metrics? And the kind of a follow-on question is, how do you, when you're working with your customers, how do you find like these metrics actually drive the outcomes for growth?
Okay, well, so I'll start with how we landed on these 10 metrics. And so this was a result of two separate projects, I would say. So one is our CEO Taylor and some of the people who are in charge of growth strategy at CTC. We would do these sort of like, I would call it like 6-week sprints where, or actually maybe it's a longer period of time than that, where we would train new growth strategists in how to evaluate a brand. And what we discovered is as we were going through that, we were landing on the same like 6 or 7 metrics every time to say like, this is what you need to do when a client comes on board. You need to measure these 6 or 7 things in order to determine whether or not like they're going to be success, like what your chance of winning with them is. And so then at the same time, we were also doing work, this is a couple of years ago, on something we call the anti-fragile scorecard. And that was just sort of an indicator, like as we were seeing from like maybe the indicators that we were seeing in our own brand, what did we think that the sort of indicators of a brand that could survive tempestuous times, maybe I could put it that way. Like what are the characteristics of that brand? And so the Diagnostic Toolkit is a combination of anti-fragile metrics, like these are the things that make your business survive, and then growth metrics, these are the things that make your business thrive. And we kind of brought them together. So I'll just say like maybe that's like a shorter answer would be, generally speaking, like what are the shared characteristics of the brands that we've really been able to win for, the brands that we've seen a lot of success with. And I think the answer to that question lies in these 10 metrics. Like those brands are doing really well, and it's pretty replicable. Like if a brand comes in and it's like, oh, they're really crushing it, let's run a diagnostic report on them. And as it turns out, they're pretty much over the benchmark on all of these things with some variation. So that's a long answer. What was your second question again?
Second question is, as people go about, like, do you find that as people apply improvements to these different metrics, that they do see and improve their ability to grow, improve?
Yeah, I think, yeah, definitely. And some of that is just sort of self-explanatory. Like if your first order value, like if you become profitable on first order, that'll just sort of inevitably be good. If you start making more money in 60 days, that's going to be good. If you have more cash on hand, that's going to be good. So there's definitely a correlation between the client success and how much they're able to improve this metric. There's some nuance to that as well. Like I think a lot of the times people's FOV to NCAC can be actually too high. Their score can be too good, and it might be worth bringing that down so you can actually bring in more volume. So there are other factors to consider. And so having a great score here may not necessarily mean success over the next few months, but it does give an indicator that there is something here to build on that you could find success with in the long term.
Because what you're looking at is growth potential, right?
Yeah.
I would argue that if you have growth potential, one of the fuel is probably cash. You're going to need cash. You apply cash to your business, and you should be able to see growth. But one of the challenges of growth is cash demands. There's a question around how is that calculated? Is each category worth 10 points and then there's just an adjustment, or how does that work? Yeah,
so some of this is a little bit like, some of it's straightforward, like with cost of delivery and OpEx. It's as simple as like the number of percentage points you are over or under equates to the GQ score effect. For others, it's like 60-day incremental growth percent, 1 year incremental growth percent, FOV to NCAC. They're all that percentage over or under is adjusted slightly just to allow for, I would say, the way that the sort of general data set looks. But that's kind of like a confusing way to say it. But what I mean is that like, if we were to make 1 year incremental revenue growth percentage as simple as percentage over or under that benchmark, the swings would be really, really wide. And so we just have to take into account just like on average, where do people land? And so this is essentially built so that on average, your GQ, no one of these is going to swing your GQ score more than 30 points. Initially, let's say, for instance, we had cash conversion cycle having a much bigger effect. But then when the cash conversion cycle started rolling in, and it became clear that some people had legitimately had 200-day cash conversion cycles, and the business was still doing okay, it was like, well, we don't want to have such a massive impact on your GQ that it creates a negative GQ score overall. Yeah, so I would say some of them are sort of like powered up or pulled back based on kind of where people are landing on average against these different metrics.
Okay, one more question. Do you pay more attention to new customer acquisition or returning customer value if you had to prioritize one over the other?
That's yeah, it's a complex question because the answer has to be both. I would say like this is maybe a good indicator of where you have to look. Like if your revenue growth percentage was higher and your first order value was lower, that's maybe a good indicator that that's where you need to look. But let's say, for instance, the example you're talking about here, like you're below benchmark on both. I would say maybe focusing on, especially if you have a negative FOV to NCAC, I would maybe focus there, just because that just means you're losing cash. And if you don't have the retention to sort of back it up, then I think the more urgent issue is your FOV to NCAC rather than your 60-day LTV. But I would say on maybe at larger sizes in the 50 to 100 million range, an issue that we see is an over focus on returning revenue, maybe because it's easy. And what happens is that people ignore their new customer acquisition and eventually they just sort of run out of new customers. So there's a separate thing that you have to measure is like, how many new customers are you growing by per month? And because if that starts to shrink, then eventually the amount of returning customers you have will start to shrink too. And then you'll just sort of like run out of customers in general. So I would say like for a larger brand, probably making sure that you're focusing on new customer acquisition is probably more important.
And one more question. Sorry for the elementary question, but is CAC included in the cost of delivery or is it purely variable costs related to the product sale, inclusive of marketplace fees?
Yeah, it's just product costs related to the sale. So CAC is not included in that. We measure that separately.
All right, that's all the questions. I know we're about the top of the hour, so let's just talk about next steps if somebody wants to learn more about the e-commerce diagnostic toolkit.
Yeah, so I think for attendees of this webinar, we want to extend a special offer. CTC has a membership program called Admission that's attached to it. And essentially what it exists for is to give businesses, particularly between 0 and 1 million in annual revenue, a chance to get agency expertise without actually having to pay agency fees, which as an agency ourselves, we can tell you are often pretty high. So Admission is a monthly membership that gives you access for a much lower price, right? And so an all access pass to Admission is, we don't usually offer this, but we want to offer it to attendees of this webinar. It includes the Diagnostic Toolkit, which is normally $297. It includes an Admission membership, 30 days of Statless, our enterprise scaling guide, which is kind of the overall like foundation of all the principles behind the e-commerce diagnostic toolkit. And I think is really helpful, makes a really helpful pairing with that. And then 3 months of a subscription to the D2C index, which is our weekly newsletter and then data. So we have a sort of data site that updates trends in the e-commerce space. So you would get all of that for just $299 a month, which essentially is the same price as the e-commerce diagnostic toolkit. So we want to extend that to you guys because we think there's definitely greater value there, and it'll help put the diagnostic toolkit in context, which I think is really, really important. So after this webinar, we'll have you guys kind of send out a link so you guys can go ahead and check this out, sign up. And if you have any questions, like we're happy to answer them. But we think that this is probably the best way to get the diagnostic toolkit and to get all the tools around it that you need to really make it effective, all for essentially the same price as the e-commerce diagnostic toolkit.
Awesome.
Yeah.
And obviously we do accounting services. So if you are having a struggle calculating some of those financial metrics, that's what we do as well. All right. One final question for you. If you're already a member of Admission, can we get access to Statless or the DTC Index Enterprise Scaling Guide?
Yeah, absolutely. Just reach out to me directly and we'll sync you up with that. Okay. So the all access pass it's a $299 a month. We ask for a 3-month commitment. So, but reach out to me directly and we'll be happy to upgrade you to that.
Okay. Thank you for your time today, Richard. This was awesome to discuss. Hopefully it was good for everybody that attended, and we'll see you on the other side.
All righty. Take care, everyone.
Take care.